Joining me now with more is Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, it's great to have you on the show this morning. And let's start with the Fed, of course, cutting rates as expected. Questions about rate cuts going forward. Where does this leave the bull market?
Yeah, happy Friday, everyone. And that was really inspiring there right before I came on. Happy Veterans Day to everybody out there. Obviously, news help serve and keep us safe. So thank you. Veterans Day weekend, I guess we'll say. So we'll talk about the F word, right? The Fed. The Fed did cut for the second time yesterday. Now, there's a lot of ways we can go about this. I'll keep it high level. We have been in the camp, Kristen, all year that inflation is last year's problem. I know headline inflation is not quite 2%, but if you take out shelter for like 6 months now, inflation's been right around 2%, okay? Even sub 2% in a lot of ways. So we think the Fed can be cutting. Because that's the big thing. We thought they should have cut, a couple meetings ago when they didn't. Then they did 50 basis points. Now they've done 25. The reality, again, we have historically high productivity in our country. Keep this real simple. When you have high productivity like we do for an extended period of time, we've been bullish because of the high productivity. It puts a cap on inflation. It allows for higher wages. It allows for the Fed to cut and not have a big surge in inflation. We saw that in the mid to late 90s. And again, that's a really good time to be long, but look, we're looking at 2 years in a row up 20%. We've been talking about this for a while, so we're not too worried about the Fed cutting a couple times and inflation coming soaring back. So one more comment here. If the Fed, we don't think we need rates still up around 5%. I mean, that's the best way to put it. They can continue to cut here to help unlock kind of the housing market, small businesses. Obviously, small business confidence has been low because higher rates usually don't help small businesses all that much. There's some reasons they can continue to cut. Last point on this, though. So the Fed cut with market at the all-time high. You ask yourself, can they really cut with the stock market at all-time high? The answer is yes. I went back to 1980. 20 times the Fed cut when the S&P was within 2% of an all-time high, like we just saw yesterday. 1 year later, S&P's higher, ready for this, 20 times, up about 14% on average. There's lots of other stuff to look at, but the reality, put a cherry on top here, the Fed is no longer a headwind. The Fed is a tailwind, and we think more cuts are coming into next year.
So that's interesting, Ryan, because there is some concern that inflation could be sticky at these levels or even pick back up, of course, as we wait to see how the House race unfolds. But it could be a red sweep across D.C. What's your view on inflation?
Yeah, well, kind of like we talked about there, we're not too worried about it. I mean, you got wages coming back, you've got the supply chains opening up. Again, I know that's the worry because the Fed did not have the best track record. Let's be honest about transitory. The worry, they start cutting. It's obviously an election year, all that stuff, and then you see it come soaring back. But like I mentioned earlier, we're not too worried because we have really high productivity. When you have higher productivity, that can put a cap on things. But you mentioned kind of the red sweep and the Congress. I mean, you look historically. When you do have a red sweep, stock market doesn't really do that great. I mean, it does okay. Well, the bottom line is this. Maybe put it like this. When you have a split Congress, this will be the 13th year in a row stocks were higher. So we know the Senate's obviously Republican. You've got the House that's probably going to go Republican just by a little bit. I mean, gridlock is good. You don't want too much power one way or the other. So, we're going to hear lots about the makeup of Congress and the White House. And yes, stocks have done better in a Democratic president historically. But you know what? Stocks have done a lot better when Republicans control both chambers of Congress than when Democrats control both chambers of Congress. We can slice and dice this all we want. The reality, again, is we don't think inflation's a worry. We think the Fed can cut a couple more times into next year. And honestly, the economy still looks pretty darn strong to us, led by record earnings and strong productivity. Those are tailwinds why we've been bullish since December of 22, and we're not changing yet.
Yes. Well, then you called it right, Ryan, because, of course, we saw the market bottom in October of 2022. And now, of course, in its second year, you're very optimistic, it sounds like, about where we go from here. But we have seen some repositioning in the market in the wake of Donald Trump's decisive election victory on Wednesday. Small caps finally picking up some steam, outperforming that day after they had been underperforming for the first 2 years of this bull market. What are you recommending to clients?
Yeah, I mean, let's put it this way. A diversified portfolio, first things first, right? Everybody talks about technology and it's done wonderfully, but you don't always want to chase the shiny object. So to us, the portfolios we run at Carson Group, we are overweight. You mentioned small caps. We've been overweight mid caps all year. We really like cyclical, specifically industrials and financials. And you think about what just happened here with the policies and potential policies and the election and the uncertainty of the election out of the way. Hey, There's deregulation coming. All right. I mean, we know that. And the financials had a huge day, up to over 6% on Wednesday. Small caps up about 6% on Wednesday. I wouldn't even say they're playing catch up because they've been doing okay this year. Financials specifically been doing really well. So again, if you don't see a recession like we don't, those are the areas we've been overweight all year. And then we continue to like them. All right. Our portfolio's done pretty well this year, all things considered. We think there's still some more upside to those groups here.
We've been hearing our guests talk more about the best 6 months of the year. Of course, it usually does run from November to April. What gains, Ryan, could we see in that time frame this year?
Yeah, that's a good point because we just left the worst 6 months of the year. Selling may go away is what we hear about, right? And now we had a really good period, by the way. We gained over double digits like 5 months in a row. We went higher during when you're not supposed to go. So that's when you're not supposed to go higher. So what's unique about that, these next 6 months, so November through the end of April, up almost 80% of the time, up over 7% on average. The very best out of all the 6 month scenarios out there, these are the best 6 months. Let's not ignore that. Now, we've had a heck of a run going into it, we're aware, but it's still more positives for the bulls. Now, here's what's unique about it, though. When you're up double digits during the sell and may go away period, so the worst 6 months we just left, so strength during the worst 6 months, like we just saw. The next 6 months, where we are right now, the returns go up like 13% on average. In other words, double the average returns during a really strong period. Get even better when you're strong the 6 months going into it. So these are just little building blocks. You start stacking all these things on top of each other. We are still optimistic. We thought we were going to see a year-end chase. We actually added a little more equity risk a week ago right now in the Monday that we run. We had the Halloween massacre, right? Stocks did terrible a week ago on Thursday. We added a little bit because we saw once the election's out of the way, we weren't like who's going to win, who's going to lose. It was just to get the uncertainty out of the way, and that's what the markets don't like, uncertainty, and that removed itself. And obviously, like you said, like before I came on, had the best first day rally ever, had the 5th largest point gain ever in the Dow. And I get it, points versus percentages, but the reality is, this is still a bull market. We still think there's gonna be a chase into the end of the year.
Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, thank you so much for the insight. We'll check back in with you after the market opens. Ryan, great to have you, and it looks like we are going to round out for the S&P 500 the best week in a year on this Trump victory, up more than 4%. For anyone who's been on the sidelines amid what have been elevated interest rates, is now a good time for them to get into this market?
Well, thanks for having me back here, and boy, I hope there's not too many people that have just been sitting on the sidelines the last couple of years. But let's think about it like this real quickly. This is the best week, like you said, in a very long time. What did we see just recently? We saw a lot of put buying, right? So a lot of hedging. We saw the VIX go from sub 15 to over 22. A lot of people are expecting volatility, right? When everyone's thinking like somebody isn't thinking, General Patton, we had all this kind of skepticism and all these hedges, and then the election came off without a hitch, and all those hedges unwind. And listen, a huge rally this week is not a big surprise I'm getting at. I think we expected that. I mean, November's higher 11 of the last 12 years. November's the best month since 1950, the best month the last 10 years, the second best the last 20 years, and the best month in an election year. So, this is happening. Now, for people who are wondering what to do right now, I mean, we're still bullish. We're still optimistic. Now, maybe you wait for a little bit of a pullback. I mean, we are pretty darn stretched here. But I'll put it like this, Kristen. When you're up 17.5% for the year going into November, or the last 2 months of the year, like we were this year, right? Like we were. November has been higher 12 out of 14 times. December has been higher 11 out of 14 times. And these last 2 months, when you're up 17.5% for the year going into them, has been higher 14 out of 14 times, up 6% on average. So the honest truth, we manage money. I know a lot of other people that do. A lot of people have been underweight equities, overweight bonds, been very lopsided, been very wrong. And that can be one other reason as money kind of chases in. It's cliche to say, cash on the sideline, but there truly is a lot of cash on the sideline, and it's still reason to think we're still in a bull market here.
Just ahead of the opening bell, Ryan, my colleague Trinity on the floor was talking to Trey Bodge, well-known retail expert, certainly a friend of mine, of course, over my time broadcasting, but she was giving us a great rundown of what we can expect this holiday shopping season. We've talked about small caps. We've talked about big technology names. I want to get your take on the retail space, too.
Yeah, I mean, listen, the consumer is still solid, right? And you look at consumer discretionary relative to consumer staples is kind of one of those things that people like to look at for risk on, risk off. That just broke out, right? So the message of the market is telling us is there is some strength there. Now, listen, I can't talk individual equities, nor do I really follow individual equities. So there's going to be winners, there's going to be losers, but the reality again is the underlying pinnings of this economy are still solid. People are still employed, right? Look at initial claims; they were spiking when we had the horrible hurricanes that went through, but they've come back just as quickly. You look at wages, right? Real wages are still growing comfortably more than inflation. Now they've come back, yes, but so has inflation. So the reality is the backdrop is still solid for the consumer. We expect to see another strong holiday season. It is what it is. The consumer in the U.S. does like to spend money, but most people have jobs and most people's incomes are growing faster than inflation and have been actually for quite a while. And that's why we've been pretty optimistic on things. And that's still a real big solid driver for this economy and this bull market.
So, Ryan, I do want to drill in on jobs because we did see what many would consider an outlier and maybe a one-off, really, in terms of the jobs report for October, right? Just 12,000 jobs added. That was amid the Boeing strike and 2 hurricanes, both Helene and Milton, coming in that number well below economists' expectations. Do you think that was a one-off and that the jobs market can remain strong, especially into the holidays?
Yeah, great point there. We do, and obviously the market does too, because since that jobs number came out, we've gone up a lot. So the market's looking past it. But let's be clear, things are slowing down, right? We made like 4 million jobs not that long ago during the year, averaging, 400,000 jobs a month. Now, we're getting closer to last 3 or maybe 6 months, we've averaged about 150,000 jobs a month. That's not what we were seeing this time a year ago. It's not what we were seeing 2 years ago, but that's okay, right? A lot of people are employed. The economy is still growing. You look at things like layoffs. We are not seeing any layoffs, right? I mean, until you start to see layoffs start to spike. Now, it's not like people are just jumping around. I mean, a lot of people quit jobs and got a new job in 22. We're not seeing that anymore either. But this is an aging labor market, but again, one that's relatively full and will continue to grow, in our opinion. So listen, between 100 and 150,000 jobs going forward per month on average is fine. Last thing here in 2019, things are pretty good. Last I checked, the market was doing good, economy's good. We averaged about 165,000 jobs a month in 2019. Now the labor market's bigger now, I get it, so it's not quite apples to apples here. But the reality is, again, this economy is still growing, and the labor market's probably going to stay solid, in our opinion.
Ryan Detrick, so good to get your take. Ryan's the chief market strategist at Carson Group. Thank you.